Smart money behaves differently. To discuss how to invest, I'm in conversation with asset manager Surya Bhatia. Thank you for your time.
Thank you, Mika.
So, markets are down. How should serious investors think right now?
See, I will not like to use the word serious investor. Huh? I think if you're doing investments, it's pretty serious business otherwise also. Okay. So, but you should look at this as an opportunity. May not be looking very nice when I say this to you, but that's the way any investor should look at it. Find opportunities, when to invest. If markets are down, you may call it in a retail manner. It's like a sale going on. You get something very discounted price, getting cheap. Look at that as an opportunity for yourself, and why not?
We have a war going on internationally. How should people behave when it comes to investment?
These are events, not good events, but then these events are giving you opportunities to look at your overall investment perspective. Please go back to the drawing table, understand what your needs are. If you have an option to invest in markets at these prices, just start entering more gradually. Maybe 2 years, 3 years down the line, these valuations may look very nice to you.
The wars and its impact on oil and gas. Should we be worried?
Worried, yes. I cannot say that you should not be worried. Everyone should be worried about it. And that's the reason if you see the oil over the last few days has gone up by 35, 36%, if I'm not wrong. And for India, who kind of imports oil, it's of course not a good sign. But yes, we have to live with this and see how best we can use it from here.
For high net worth individuals, is this accumulation time or capital protection time?
See, the answer to this lies in the need of money. And it's not about HNIs for that matter. Anyone who has assets, who has money to invest, and has a long-term play for investment should look at these opportunities as accumulation. But yes, someone has a goal coming in or a need coming in, maybe 1 year, 2 years down the line. Even if it's a very good opportunity for that investor, we will not recommend him to look at that as an opportunity there.
Should asset allocation change during geopolitical tension? What is the ideal allocation and how should it kind of alter during a geopolitical tension?
See, there is no reason to change it because when I mentioned that you need to be a little bit more need-based, goal-based planning for your asset allocation. So I'm assuming that whatever is meant for long-term is actually gone to higher riskier asset classes, for example, like equity. So, and if the war happens now and you're still holding true to your goals, nothing changes for you. But yes, rebalancing, adjusting your portfolio, adding equities or using it as a special situation for yourself is something which a smart investor can do from here.
Is this when wealth is actually created?
Wealth is created by compounding. These events only gives you that little bit of alpha or a little bit of push for your markets to really help you to come at good levels. But you cannot create wealth through this only. Compounding is the wealth creator, which means you have to stay invested. You have to stay invested for long term. That's where the real wealth builds for you.
Historically, how reliable is gold during war?
See, gold does carry that benefit of when the markets are tough, conditions are tough, gold as an asset class thrives. See, because just look at it, intrinsically, gold does not carry any value. So then when will gold do well? It will do well only in a time of uncertainties, when there is fear around, when there is a currency debasement happening. That's a time when commodities like gold tend to do well, and that's exactly what we are going through over the last 15 months, and more so now.
But having said that, the gold prices really haven't increased in the last few days.
You can't look at any asset class with few days perspective. You're not going to a casino, okay? You can't make money in 24 hours. I wish I had the answers for this again, Amika. But if you look at the last 1 year, gold clocking the scorching return of what it did, I think I can't complain.
In today's macro environment, is gold insurance or an investment? As we've seen it did so well in the last 1 year.
See, we call it as a hedge to equities. We call it a return equal to your inflation. It deserves a place in everyone's portfolio for sure. But what the key part is the allocation. You need to check it out, how much allocation you need to create in your overall portfolio of things. So typically 5 to 7% or up to 10% is what you should look at as an allocation between commodities, which would actually do the trick for you in the long run.
Okay, and what should the rest be? So 5 to 10%
is your goal, commodities.
And the rest?
Rest can be a basis your needs, basis your goals. It could be your equities, could be your debt, could be your global equities also. Now again, as I just said, Equities are meant for long term, and provided you also have that risk appetite in you, you have the risk capacity in you. Subject to that, subject to your need of money, equity should be considered as an asset class.
Is silver a tactical trade or a long-term hold?
See, silver is a commodity. Silver typically you can call it runs in line to gold to a large extent. But in good times when the asset class is doing well, the returns are again far superior to any other commodity. When I say any other commodity, I typically mean gold over here. But the vice versa is also true. When it corrects, when it crashes much more than what, let's say, gold will happen. And that's exactly what we are seeing over the last month and a half. And that's the way silver will always behave, because it's also a industrial asset class. You have to be understanding this concept. You just cannot blindly compare silver with gold. Because it's an industrial commodity, the overall need of silver also plays a very important role in determining the prices of it.
Gold ETS versus physical. What's smarter for the fluent investor?
ETF, that's a simple one. Physical comes with its own challenges, come with the risk of storage, risk of purity. How do you manage that? How do you really sell it? So ETF, a paper gold is the way you call it as, I think is the best way forward if you want to buy gold. And also in India, the gold through this route is also backed up by physical gold. So just to give you an example, in COVID times, all the sale of the gold funds, the ETFs and the funds were closed because the physical delivery could not be transferred.
So which ETFs do you recommend?
See, ETFs are all passive strategies.
Yeah.
So I'm not saying any names over here. Just pick up any of the gold ETF with low cost and that should do the trick for you.
How do you advise people should invest in their 20s, 30s and 40s, and how does it change?
See, one very simple example I can give you is just reduce your age from 100 and that should be your equity. It simply means the younger you are, higher your equity as a class. But this is a very generic one. You can go to specifics about your overall financial well-being, your family surroundings, and then see how do you really need the money going forward. If you think you can save some money which you will not touch for the next 10, 15 years, it's just a no-brainer. Please look at equity as an asset class because that's where the real compounding happens for you in the long run. For me, that's the critical part. Any part of the money which you think you can put for 10 years and more, equity is the way forward.
At which point of one's life should one look at international exposure?
I think that deserves a place in your portfolio now, more so because of the overall, I think, geographical diversification which we are all seeing, including our country. So everyone's portfolio deserves international exposure to it. Within the basket of whatever you determine, let's say an equity. So example, let's say you say overall equity should be 50%, just to give you an example. Then within that 15%, you can actually have around 10 to 20% exposure of that 50% in the global markets.
And how does one enter the global markets?
There are two options you carry. One option is, of course, you can buy the funds within India, which are called as feeder funds, which can make you invest in global markets. The second option is through the LRS route. In the LRS route, you have two options. Either you can send money directly overseas and open a demat account, or buy funds or stocks in the overseas market. The very interesting second option within the LRS is you can also use the money to transfer through a gift city route. That's a new concept where you can actually invest from India to the Indian dedicated funds who will invest on your behalf to the global markets. And I think that's something which you should look at if you are using the LRS option.
And what do people usually use, which has been a popular route, and where do people invest when they're seeking international
See,
exposure?
typically up till now, the fund option was open. That's coming to a closure because of the India ceiling of which is $8 billion coming to an end. So some funds do open sporadically in between when they have their own limits being available for investment. Other than that, as I just said, Gift City is a new kid on the block. That's something we believe will catch up very fast.
All right. Now, a lot of people are seeking international citizenship. Is that from the perspective of tax, investments, investing in international real estate? Why are your clients opting for it?
See, some of them may look at it, maybe someone looking for their even their children, for their education, because if they believe that they want to have their child to go abroad for studies, that's one route which any HNI will consider that. That's one option. Some people may want to move overseas and they find some golden visa coming the route or some other opportunity coming through which they can actually go and use as an opportunity. Taxation, I don't think so that would be the reason, unless someone is really playing the game the hard way. I really don't have an answer for this, honestly. But typically that's the reason why people really want to look at as an opportunity for them to move overseas.
Is real estate still relevant for wealth preservation?
Wealth preservation is also optics over here, okay? Because even the real estate do correct. We may not see that because it's not that transparent a market. There's a little opaqueness because if I'm selling a property and I determine a price, and I think I will not sell the property at price below that, I may just be a hold that property off. I may not even consider going to the market to sell that off. I can't say that in the case of equity market. That's very transparent. So sometimes transparency doesn't help the investment, the financial investments. It helps the opaqueness helps the real estate market. So yes, and we Indians do carry the fetish of a real estate. You like it or not, but that's the way it is. So real estate, everyone do carry in their books. But when you talk about real estate as an investment strategy, it is always good to understand how much returns you expect from that strategy which you plan to. If you believe that that strategy will give you a return better than your financial markets, just do that.
Why is it that Indians are more attached to real estate as an investment?
I think we all know this, the answer on this, Ambika. When we all grow up, we are kind of given that in our head that we need to have one real estate asset, which could be my house, which could be my investment, it could be my backup plan. And I think as you grow up, you come with that thought process, so you are a little biased towards real estate. So selling real estate in India is not difficult.
How much liquidity should a person ideally hold?
See, we have all seen this in COVID times. But we always say is that keep a 6 months of buffer with you from a cash flow perspective. And that's true for a one who has a stable income, a stable job. Anyone who doesn't have a stable income, having his own business, but still doing not set it up to the way he or she would have wanted, then we say just increase that buffer from a 6 months to 9 months or even 12 months.
What financial mistakes do people make really often in their 20s, 30s, and 40s?
See, financial people don't save. And people have very less money when they are starting their career, which is very logical. Then they say, what will this money lead to? And that's what we always say, that compounding is the eighth wonder of the world. Okay, so you better start saving even with small amounts. And to be honest, besides compounding, the habit and the discipline it creates in you for saving, when you actually come with better and a bigger money portfolio, really goes a long way in helping you a lot.
Should equity exposure reduce after you're 50 years old?
See, I just gave you an example of reducing the range from 100, okay?
Yeah.
So therefore, if you look at that as a logic, then of course you can do 50% equity. But again, as I said, if you have to be case specific or a person specific, then the need will matter. So to many people, we say, you don't need to reduce equity at all because you have enough. So if you have enough, while I can't define what enough is for you, it's very relative. But if someone has enough for himself, then that part of the money I don't need to touch and move out from equity. So case sensitive, of course, but you can also use it as a thumb rule, what I just said of 50% equity.
What's the biggest regret people in their 50s have?
They have not saved. Very simple. And these, again, the same answer which I just gave you, that because they have not been disciplined enough, they think that they could have saved more or started early in their lives. And that's what when I hear from investors, they say, okay, I did this mistake, I want to make sure that my kids don't do this mistake. That's something which everyone should follow. Start saving. Convert your savings to investments.
Can portfolio mistakes be corrected in your 50s?
Everything can happen. Why not? I think if you have not taken adequate exposure to risk, to equities, what I mean over here, start increasing it even at the age of 50. But that increase can only happen if you have the long-term need of money. Short-term, even a 20-year-old person cannot look at higher risk. It's a very simple logic. You can't do that.
Is cash underrated in uncertain times?
Today's time, yes. That's what we all get to hear from. Had someone asked me this 6 to 9 months back, actually I would not even have been asked this question 9 months back. But because of this uncertain environment around us, cash, and we always say cash is king. So therefore, having cash in your pocket today for further deployment of the markets is always good.
One asset class that people misunderstand completely.
Equities.
So even now, after CNBC and so many podcasts and all of that, people misunderstand equities.
See, all these CNBCs and whatever you're saying, I think everything is talked about, but people do not get the concepts, okay? In falling times, which we are witnessing now, you still see a lot of redemptions happening. Why is that? Because people do not understand that equities are an untamed beast. You cannot expect a vertical line happening. There's no linear curve over here. You can make money only if you hold for the longer period of time. It takes good long percolation for really to justify why you put your money in equity markets. But That's the problem.
If you had to build a portfolio today for the next 10 years, what all would it have?
If it's meant for 10 years and I do have the risk capacity and the risk appetite, for me that's two important things, then equity is the way forward. But yes, you need to kind of create an allocation of the portfolio subject to 10 years of holding period, and I can take the risk tolerance for that period of time. Equity should definitely hold a lot of big weight in the portfolio, so I can assign 60-70%. Within that, assign 20% to the global markets, have 10-20% debt for, let's say, backup, emergencies, whatever you want to call it as, contingency plan for yourself, and 10% to commodities.
And within the international markets, what would you recommend?
See, within international markets, you have a lot of options. Huh? So you have to be a little bit smart over there. The US is definitely one easy answer on this. But you can also look at other markets, which are actually the good part is they are available to you for investment. But don't go too deep into it. Just look at going through typically a mutual fund, because those guys are specialists. They understand that field much better than you and me. So look at that as a strategy, but diversify.
But which international mutual funds?
So again, you have to identify that. If you are going that way.
What would you recommend?
So I'm saying if you are going that way,
Yeah.
of course you are doing a little bit of understanding about that
Yeah.
market. You're not going just because of hearsay, and you should not go because
Yeah.
of hearsay. If you're going
But
that,
what is your recommendation?
when you're starting
be?
it, just go and simply buy a NASDAQ or S&P 500. When you buy in an international market, I'm assuming you're buying in a developed market. And if that's the case, just buy the respective indexes. If I'm talking about US, just buy the S&P 500 and NASDAQ. NASDAQ carries a higher weight in technology, which could be the way forward. But of course, because of that, is also more volatile. S&P is a more industrial based. So just diversify yourself, and that will do the trick for you.
And apart from America, any other country?
See, other countries which look attractive doing and can do well, Japan is one country. China is coming up. So, but you have to be a little bit understanding that. You just cannot go in any country for investment because you don't even understand our own country beyond a point from investments. And then when you look at these countries, so better read yourself before you think of investing in these countries.
Crypto as an investment in India, how popular is it and do you recommend it?
It's turning popular the way I've been reading and hearing in the media and in the newspapers. But of course, it is not a legal tender in India. RBI doesn't permit this. And now with the new change in tax forms, I think there's a separate column for disclosure of the crypto. So because it is also not a legal tender, we just say that please be careful before you look at this as an investment strategy, because you do not carry any recourse, but then people do invest.
And last question, talking about commodities, where do you see gold and silver going?
I wish I had the answer on this honestly.
Tentatively.
Silver looks very volatile to us. Can do well. It has corrected from the peak a lot. January was a very volatile month. It went up 30-40%, both sides up and down in this 1 month only. Gold has been more steady. It also corrected, but that's the way gold has been. I think long run, we still believe gold needs to be carried as a weight in your overall portfolio. And silver allocation can also happen in the portfolio, but please be wary about the volatility and do not carry a limited number of allocation which you want to create in the strategies.
All right. Thank you so much.
Thank you.